Well, hello and welcome. So let's have a look at what's going on here in 2022. When we look at the SPX, the best gauge of the overall US stock market, we are below the 200-day moving average. When we look at our 92% opening range method, we can see we have, as of Friday, we are now neutral again. So we're not bullish, we're not bearish, we are neutral right now in our opening range. This will be reset on the first trading day of the month, which will be Tuesday, and we'll have a new opening range on Wednesday this week. So we'll keep a close eye on that. But right now we are below the 200-day moving average. This could be forming a bear flag here, which will then it's bearish, likely to break and continue to move to the downside, right? So it could be a bear flag forming below the 200-day moving average and could move down significantly lower. We'll keep a close eye on that. We're right in the middle of earnings season. A lot of companies reporting their earnings, and that can have an impact on what's going on as well. We know growth stocks are in trouble right now. A lot of them have been down 20, 30, 40, 50, 60%. And having said that, there are some stocks there that are showing some very good value right now because of this sell-off. Maybe a little bit overdone compared to their intrinsic or real value. But right now, neutral on the market, probably more leaning towards bearish. If we look at it from a longer term perspective, I mean, the S&P 500 is sitting right on the 50-day moving average, and we look at it from a monthly perspective, it's still above the 21 EMA. So longer term, it still looks, everything's intact, it's still strong, but shorter term, yeah, it's definitely starting to break down. There's no doubt about that. If we look here at the opening, not the opening range, the workspace, we can see that all the major indexes, the S&P 500, the NASDAQ, the Russell, the Dow Jones, and industrials and transports are all below the 21 EMA. Okay, Russell 2000 broke down out of this trading range. Same with the NASDAQ. That's been selling off. This could be forming a bear flag as well. Continue to break to the downside. That could easily happen, right? So we do have a hedge on the QQQ, which is the NASDAQ. I showed you guys that last week. Pretty much the QQQ is right at the same price where we hedged last week. So, it's just sort of breaking even right now. But again, a hedge is there to offset a loss, right? It's not there to make you a lot of money. Sometimes it can, obviously, but it's there to hedge against positions that you have in the NASDAQ, for example, right? So that's why we put that on from last week, and it's still there as we speak now. So having said that, just have a quick look here at the sectors. We can see that every sector is below its 21 EMA except for energy. That's still looking particularly strong, but everything else is in bearish territory. Okay, so if we do start to break down on some negative earnings that come out with some major companies, that could be the catalyst going forward. Inflation could still continue to move up and that type of thing. But right now, yes, the market could easily go either way. It's neutral. When we look at our opening range, it is neutral. Having said that, though, there are some positions here that look attractive. So, for example, one of the ones we're looking at is Apple. Now, what I have is I have a way of looking at the intrinsic or real value of companies. Okay. Now, this takes into account a lot of different things. Obviously we're looking at the fundamentals of the company. We're looking at the return on equity, the profit margin with Apple, which is 25.88%. Looking at the technicals, the probability of bankruptcy, the whole range of things that go into valuing a company, the net income per employee, the revenue per employee, average assets, earnings before interest, taxes and depreciation and amortization, earnings before tax, average equity, enterprise value, free cash flow, invested capital, to name a few, right? So it takes a while to actually value a company. It's quite complex. But for me right now, if I look at Apple, so let's just have a look here at Apple. Look here at Apple right now. We're trading at 170, just over 170, 170.33 to be exact. And my valuation, my real value, intrinsic value, what it should be worth as a minimum is 189.17. I'll just say 190, right? So this is undervalued right now compared to its intrinsic or real value, according to my calculations, right? So we've got an undervalued stock here, good quality, fundamentally sound stock that's growing its earnings, continue to improve its free cash flow, all those types of things. I still really do like the look of Apple. We look at its last earnings that came out. Revenue was up 11% to a new all-time record. We look at the actual earnings per share, $2.10 compared to $1.89 they were expecting, and revenue of $123.9 billion compared to $118.2 billion, which is what they were expected. So it beat on earnings per share, beat on revenue. It's all-time high as far as growing its revenues, and company's looking pretty good to me. I've got an intrinsic or real value of 190, trading at 170. So one of the things you could do is you could then, again, the market's still uncertain, so I just don't want to just go out and buy it because I don't really have a clear direction in the market yet, right? So I'm going to agree to buy the stock down at 160, okay, for $4.25 or $425 for every 100 shares you're agreeing to buy. This will be in play until the 18th of March, 47 days from now. That will generate a 2.7% return for agreeing to buy a fundamentally sound growth stock that you're happy to own anyway at a discounted price to what it's trading at right now and being paid day one. It's a pretty good deal, right? So one of two things can happen here. Apple finishes above 160 come the 18th of the 3rd, or it finishes below. Can't do anything else. So if it is above 160, you keep the $425 a contract. You're selling one put option, contract. That's what we're talking about when we say contract. $425 is what you receive in income. Okay. And if it finishes above 116 come the 18th of the 3rd, you keep the money, you don't buy the stock. If it does finish below 160, you then have to buy the stock at a cost basis of $155.75 when you take into account the put option premium that you made. In either scenario, you're very happy, right? You don't really mind either way that it goes. You're happy to own it anyway. So that's something you could do there. Now, this was a trade that we put on last week, RIVN, a bearish put spread on this particular stock. We're 25% in profit from last week. You see the video from last week. 25% in profit. You could just close out the put spread right now. Just lock in the 25% for a week. Nothing wrong with that. Or you can continue to hold. It does look as if it wants to continue to move down. The choice is yours, but that is profitable for the week. Now, MasterCard is another stock that I like the look of right now. But again, because we don't have a clear direction, I can't just go out and buy the stock, right? So looking at the real value of this stock, so let's go to the chart right here. MasterCard. Now, first thing is left shoulder, head, right shoulder. So we've got an inverse head and shoulders here. The neckline would approximately be the 200-day moving average. We just broke the neckline on Friday, right? So from the neckline, which is approximately the 200-day moving average, say 360, down to the bottom of the head, which is say 305, from 360, the neckline of the inverse head and shoulders, to the bottom of the head, 305, that's $55. We add $55 on top of the neckline, 360, that takes us to $415. My real value or intrinsic value of this stock is $415.28. So I think that's a good potential trade here. Good strong pattern here, inverse head and shoulders. Could move to 415 as our target. I'm going to be more conservative and look for it to go above 400. And I'm not going to own the stock. I'm just going to use a spread on this one, right? So you could do something like this. Set up a spread where you sell the 400, buy the 390 for the 18th of March expiry, right? $410 is your cost. $590 is your premium. In other words, a $400 investment would grow into $1,000. Okay, so a pretty good return on your risk there. So how it would look, the aim is for the stock to be above 400 come the 18th of the 3rd, 47 days from now. You sell the 400, buy the 390. It's going to cost you $410 for every one spread that you buy. Okay, maximum value, difference between the bought and the sold option, $10, 400, 390. Maximum value minus the cost, 590 is your potential upside, or $144, 144% return on risk. Break even, buy strike price plus the cost, 394.10 at expiry, right? Not your T plus 0 line, your T plus 1 line. Now, set your stop at 210. By buying it at 410 and setting a stop at 210 means your risk is $2 and your potential reward is 580. So your potential reward is 2.9 times higher than your risk. And the other thing you can do is set this up as set and forget. Yeah, so you can have a asymmetrical trade where your potential profit is almost 3 times as much as your risk, and you can have it as set and forget, automatically set up. Once it hits your profit target, it closes you out automatically for the profit. If it drops from 410 down to 200 or $2, it would automatically close the trade for you as well. So yeah, it's not a bad way of doing it. So there are a couple of ideas there. RIVN is another one you could hold. Right, still more potential profit in that one, or you can close it now for 25% return. They're just some of the things that I'm looking at for now, but earnings season is going to have a big impact on where we end up. But overall, we are still doing very nicely, continuing to generate income from our positions, and we will let the market tell us what it wants to do rather than trying to predict. All right, guys, talk to you again next week. All the best, and bye for now.